people and
Yeah.
getting to know people and kind of the real estate goal. That's kind of what I've pivoted towards a little bit, after
Yeah.
buying so much real estate myself in the past year or two. I kind of burned
Yeah.
myself out, and but now I learned a lot, and just like to share what I learned. And because I don't feel like I listen to a lot of podcasts, but I don't feel like they really give you the truth. They kind of give you like the highlights of what goes great to get you excited about real estate, but they don't tell you like the truth of like what it's like to really, really own it. So that's what I've been
Yeah. Like
trying
the
to do.
operation and the frustrations, right?
Yes, the operations,
I see.
the cash
You know what?
flow, everything. Oh, being disconnected. There you go.
Hi, sorry. I think it might be my internet. I think I might have to move room because this is like a room with crappy internet.
Okay.
Um, Let me see. Yeah, I had a chance to watch some of your videos. Like, I think I just watched two. So I kind of know a little bit about what you do, and I know you post a lot on Sarah too, which is great. And that's how I found out your link, by the way, for the YouTube videos.
Yeah.
Yeah, yeah. Where are you based in Orange County, by the way?
Well, I'm in Los Angeles now, but I was in Santa Ana when I was
Oh, you
there.
were? Okay, got it.
Yeah. Unfortunately, got laid off during COVID, so had to.
Mm,
It's harder to find a job in Orange County as a
mm,
pharmacist. I
yeah,
was in pharmacy management. It's so saturated. There's so many Vietnamese pharmacists there. It's just another,
yeah.
and then no one really leaves, so I had to, you know, relocate elsewhere. But when I got laid off was when I actually scaled the most. That's when I bought my 80 units when I got laid off.
That's because you had more time,
Well, I had like
right?
time, but also
I got
like I
it.
just used all that like anger and frustration like towards buying real estate because it leaves a sour taste in your mouth when you get laid off, especially when you poured so much into your profession. And then
Yeah,
that's what fueled me kind of scaling rapidly in a weird
yeah,
way. But now I'm okay working. That's like for now.
yeah, yeah.
But how about
Hey,
you? What's kind
Kat.
of oh hey.
So for me, I still do clinical medicine, family practice, and then I work mainly at urgent care, like in Orange County. And I sort of picked up real estate during COVID too.
Mhm.
I mainly do midterm rentals right now. My husband and I, we have two single family homes in Bakersfield.
Oh,
And I don't know. The other thing that I was looking into is more kind of like land flipping, the but before I thought about land flipping, there was that desire to own like an apartment complex too. And so when I saw your post about how you purchased them and like it's like the price of a single family home in California, I'm like, hey, I want to hear more about this. And then I found out that you're doing like seller financing. It's like what 0% down and like you're showing that you're skin in the game by telling them you're going to do all these repairs, which I think is great because like I want to invest in it, but I also don't want to put so much of my money in. So um yeah, I think I just wanted to hear more about your journey and whether you came up with it or was it something that you learned from your coaching class?
yeah, it's kind of a combination. I listen to a lot of like podcasts as well, and I was part of a mentorship. It's pretty expensive to join those.
Yeah,
And honestly, the information it's nothing new with real estate. I'll be honest. It's just a
mm,
matter like who do you like learning from, and like what type of style you like learning from. For me, I'm very like in the weeds and operational because I manage all 90 units myself right now. I renovated 40 homes in the past year while working full time, right? So I
yeah,
mean, I'm already a high level flipper, right? Like you hear all these flippers, I'll teach you how to flip. Like I probably teach you how to flip too, because I literally renovated 40 homes. But yeah, what kind of got me, honestly, I think the knowledge was already there. So if you understand this concept, um, that's pretty simple between single family versus multi. So for single family home, how is it? How do you value a single family home? Do you know?
I just I don't. I mean, I heard a little bit about your podcast. Like you value it's just based on like the appreciation. It doesn't pay based on the rent, right? But
Yes.
commercial real estate, it is based on rent. So, um, you know, that's the extent of what I know.
Yeah, yeah. So you hit the nail on the head. So you see, you're a doctor.
Yeah.
So the value of a single unit, duplex, triplex, fourplex is residential real estate. The value is based on what your neighbor's house sells for.
Mhm.
So if your
Yeah.
neighbor's house sells for $1 million, good chance yours will sell for $1 million, assuming everything's the same.
Yeah.
For multifamily, the value is based on the net operating income divided by the market cap rate. So if your apartment complex gets $10,000 a month in rent versus mine gets $5,000 a month in rent, yours is worth double mine based on that same equation.
Mhm.
Well, single family, they don't care. Like whether your midterm rental gets $20,000 a month or $1,000 a month, the value is still the same.
Yeah.
It's based on what your neighbor's house sells for. So once I learned that concept, it really blew my mind because in California, it's mostly appreciation, right? You know, I'm from the Bay Area. I'm Los Angeles now. Like you buy a single family home, you know, single family home is about $1 million on average now in OC. But you can't rent it out for maybe like close to 4,000 if you're lucky.
Yeah.
And then you're not going to break even at all. You're going to be negative cash flow, and it's not even including property management or capex. That's just purely based on, you know, your PITI. So once I kind of learned that, I was just like, well, it's hard, right? I can't leave my day job if I buy a bunch of these properties because you're making money via appreciation, not through cash flow. Now, don't get me wrong. My single family homes, like my first one I bought in 2017, I bought for 800,000. It's worth 1.3 now. So I made $500,000 in net worth doing nothing, essentially. I just lived in it and I rented it out. But with apartments, you know, when I say apartments, that's 5+ units. You know, like I was looking at Oklahoma and it was just like, wait, I can buy a 26 unit for $500,000, which is like less than the cost of a condo.
I know, right?
Right? Like I lived in San Francisco, right? You can't even get a condo for $500,000. And, you know, day one, I was getting like 10K a month in gross rents. So if you were to buy a condo in like, you know, OC for $500,000, the most you can get is like $2,500, right? If you're lucky. So once I learned that, I was just like, oh wow, like, so I bought it for $500,000. I used direct mail for that. So I'm sure you know my story. So I sent out direct mailers. I negotiate directly with the owner because I don't like working with brokers because they don't give you good deals. Number one. Number two is they don't trust you if you don't have a track record. Like they don't care if you own like 10 single family homes. When I bought my first apartment, I already owned 5 single family homes. They don't care about that. They want to know that you have actual experience operating a business. And because apartment complex is operating a business, single family home, it's just kind of like, you know, anyone can do it. So I had no track record, so they wouldn't bring me the deal. Lenders won't like you either because they'll ask you, show me your real estate resume. I was like, what? What's a real estate resume? Right? And it's just like this is a job application. They would ask for that. So what I did was instead of depend on brokers and lenders, I wanted to find a deal so good that a lender would give me lending just because I bought it so well. And that's exactly what I did, right? I got it for $500,000. It appraised at 750K day one, right? And then I have the ability to raise the rents from 400 to 750.
Yeah.
And I'm currently doing that. I've been doing that because I'm renovating the unit. So I almost double my rent. What does that do to the value of my apartment complex? It's going to double the value, right?
Yeah.
So appraised at 750K. When I'm done with it, I'm almost done with it right now. Actually, it's going to be worth around 1.5 million, 1.6. So I bought for $500,000. I put in about 300,000 to renovate it. So I'm all in for 800,000 and I doubled it, right? So at that point, you can do a cash out refinance if you want to, and then pull out your down payment, pull out your renovation costs. You know, basically have no money in the deal, still cash flowing, and then you take that money, you buy another apartment complex. That's how you scale, right? Or an alternative is my loan's only 390K on this property. My mortgage payment, believe it or not, it's only 1,900. Right? And then rents right now, I'm literally getting about $13,000 right now. And I still have 6 units I need to rent out at $700 each. So that's another $4,200. So my gross rent is 18K. So think about it. You make 18K gross, half goes to expenses, 9K, 2K for my loan. That's 7K net, right? That's basically a pharmacist salary right there. Which is one property that cost me half a million dollars to do. And you can take that 7K a month, pay down your loan faster if you want, if you don't mind working. And then once you own that asset free and clear, you're making 18 to 20K gross a month without any loan or debt on that. Assume half goes to expense, that's 10K a month, right? That can replace an income, a pretty high income. And it's tax-free income, right? So that's like take home 10K. So once I learned that, I just said, wow, this is crazy, right? So I just repeat the process. That's how I bought my mobile park. I got that one seller financed. I did have to put about 100K down, got it for $1 million. And in the process of selling it right now. That one is not as much of a win for me because mobile park, it's definitely a harder asset class. If you listen to SAR, people always talk about, oh, I want to go to mobile home park and whatnot, but like it's so much work. It's like 5 times the amount of work to manage a mobile home park than it is to manage an apartment complex. So what I've been telling people is, had I just put that money to buy another apartment complex, I'd probably be in a better financial position and I probably would be a lot less stressed. Right. So that's what led me to ultimately selling it. And then I got my 20 unit apartment complex, which I bought for 350K, believe it or not. And then I finished, renovating all 20 units, putting about 120K. And my appraisal came back low. It only appraised at like 520K. I thought it was going to appraise at honestly 700K. But because interest rates doubled over the past year, and when interest rates double, cap rates go up. Right? So if you look at my equation, net operating income divided by cap rate, if you divide by a 1 cap, you're going to have a higher value versus you divide by a 10 cap. So the cap rate went from like 8% to 10%. So that decreases the value of your asset. But, this property, I'm grossing 10K a month and my loan is about 2,600 at 7% interest. Right. In like a couple of years, when interest rates drop back down to 4, I'll just refinance, probably pull out some cash on top of that as well. So, that's what I kind of did and how I kind of scaled. And I leveraged my single family homes in California to basically buy all my apartment complexes and mobile home park. So that's kind of like a high level. I bought all my deals off market, no broker involved. I wrote the contracts myself. I negotiated everything myself. I basically did everything A through Z.
Did you get a real estate lawyer involved in this?
Nope, just title company.
Title? Okay.
Yeah, because most states, they have generic forms. Like if you Google Texas real estate purchase and sale agreement, there's a generic form. It's like 5 pages. You just read it. And if we're smart enough to finish pharmacy school or medical school, I think we can spend an hour to 2 to read a 5-page purchase and sale agreement. And you can even ask the title company that you use, say, hey, do you have any sample purchase and sale agreements that I can use? It's pretty generic. Like you just list what the purchase price is, what's the earnest money deposit, how long do you have for due diligence, how long do you have to close, and you're going to prorate the rents, you're going to prorate everything. It's pretty simple, like at a high level. That's what it really is. So that's all brokers. Once I learned that, I'm like, geez, these real estate brokers are useless. They don't know anything. They just give me this generic form that they filled out. It just makes
they do the admin work, right? Don't they do?
No, I've got 3 deals A through Z myself, and I'll tell you, it's easier when I'm just involved, right? Because like most of it is just like dealing with the lenders. You have to give them documents. If you do seller financing, you know the deal of lenders, even easier, right? So by going direct to owner, that's how you get creative finance deals. Like the next deals I want to buy, I want to put 0 down on my deals when I'm ready to buy again. I don't even want to put any of my money in the deal. I don't want to partner either. I just want to buy deals 0% down. So you have to find like owners who are distressed, right? So that's what I try to do with my direct mail. I mean, we work in healthcare, right? So, every day I see people die, disability, there's divorce, there's disagreement. That's when people want to sell, and that's when they're motivated. And sometimes they may not just want the money. They just want like mailbox money where every month they're still getting paid without having to do the management, right? So that's where you come in with, seller financing as an option, as a tool. And I think with interest rates being this high and banks being this difficult to work with, Like it took me 90 days to do a refinance on my 20 unit. It took me 45 days to buy it, 90 days to refinance. How does that make sense? Refinance is supposed to be easier and faster.
Yeah.
But because the lending market's so terrible, that's, things are difficult. So that's why like I'm really big on like direct mail and then like going direct to owners. That's how you get good deals. That's how you get seller financing. And that's how you can buy small apartment complexes under market. Once you involve a broker, they're going to jack up the price, right?
Yeah.
Like that's just the nature of it. So yeah, that's kind of how I kind of scaled.
In terms of like the mailing, I think you mentioned you mail out, was it 300 or 3,000 a month for 6 months?
Yeah, for me, I start off 300. So I use PropStream for my data.
Yeah.
And then I
Is that
use
like a good number that people use? Because I know for land flipping, it's a lot. Like for land, it's like a few thousand a month or something like that.
Yeah, it just depends on like how big your data list is, right? Because obviously there's a lot more land than there's going to be apartment complexes. So I use PropStream for my data. I refer a link that you can use. I think I have some videos of me doing an overview of Property Radar, but they're very similar. Basically what you do is you want to pull a list, right? So let's say you want to target, Oklahoma City. You basically put in a county, and you put in about 10 filters related to multifamily. And then from there, they'll give you a list of all your properties, right? So my list in Oklahoma City is around 600. So I just figured, if I'm sending 1,000 a month, well, I'll hit my whole list every month, right? So my goal was I wanted 300, because why 300? It's just a little pilot to see if the letter that I'm sending hits with owners. And I will say the fact that like you're a doctor, it's a leg up, right? If you have a esteemed title, it looks more credible and more professional, because we're basically, I'm Asian, I'm sending letters to Oklahoma as predominantly white. How are they going to trust you? But when you put like Dr. Stephen Nguyen in front of it, because
you actually use the doctor when you do your direct mail?
Yeah. Okay. So you want to leverage your title, right? If you're a nurse, if you're a veteran, if you're a doctor, whatever you are, if you have an esteemed title, leverage it. They take you so much more seriously. And let me give you an example. Like one of my students sent letters out, and they don't have a nice title. They get these, people calling back saying, "Oh, you're from California. I don't like your politics." Well, that has nothing to do with me wanting to buy your apartment complex, right? But you just get those type of people. But like when I use my title, I never got like an angry caller to me, because they respect you more, right? Because you're a doctor, so you want to leverage your title. And so PropStream for the data. I use Yell Letters Complete to outsource my lettering campaign. And then
what is
from
it
there,
called? Yell campaign, you said?
Yellow Letters Complete.
Yellow. Okay.
Yeah, and then from there, basically, I send out 300 letters a month, and typically you get a 1 to 3% response rate. So if you're in like a hot market like California, Texas, Florida, 1%. So expect about maybe 3 calls a month, and then it's going to be about 9 to 10 if you're like in a not as hot market like where I'm at. So it's definitely discouraging. Honestly, in the beginning, it's discouraging, right? You send out these letters, and you're obviously investing money, and then you're talking to owners. A lot of the owners, they're not serious. They're just trying to fish and get a high price. But then when you get that one owner that's willing to play ball, it pays for everything, right? I did 300 letters for 6 months, and I literally bought 2 apartment complexes that made me $300,000 of equity day one. So I spent $3,000 to make $300K of equity day one.
Oh, Kat can't hear anything.
Oh,
I can hear. Can you hear us, Kat?
maybe try.
Maybe try exiting and go back.
Yeah.
I don't know. Oh, you know what? I'm gonna type it for her. Okay, try to exit, and come back in. Yeah.
Yeah.
I wonder
So
if she's even typing.
that's kind of how I got kind of started there. So it did, like, I definitely would say I'm probably a little bit faster than most. And the key is, so the point of the letter is to get them to call you. That's it. It's very simple.
Yeah.
Like,
Yeah.
so there's a method that I basically teach, and you want like an invitation size envelope. So they're smaller, right? It's an A2 size envelope. And
Okay.
then after you get an A2 size envelope, what you do is you don't actually seal. So we actually handwrite the owner's name on the front.
Mm-hmm.
Oh, can you hear now?
Can you hear us?
Yeah.
Oh, okay. There you go.
Okay.
So yeah, that's kind of how I started my direct mail.
Okay. I'm curious, how did you pick Oklahoma again?
Yeah, people always ask me that. Um, honestly, I had a good property manager there. That's it.
Yeah. And that's the property manager that you got through your mentor, right?
Yeah. So
Got
he
it.
referred me one property manager, but what I kind of teach is you want to get at least three. So because you want backups. So that property manager was from my mentor, but the other one I found myself because that was out of their range a little bit. So I have two, but I have a backup one after that in case, you know, they don't pan out.
Yeah.
So, so, you know, they have their pros and cons, you know, obviously. But yeah, I got referred a great property manager, and it's just landlord friendly. Property tax is not as high as Texas. It's a steady Eddie market. You know, it doesn't really go up and down, regardless if it's a recession or bull market. So that's why I really like it. I call it the unsexy market. It's just like the Southeast, right? That's like Arkansas, what is it, Oklahoma, you know, Alabama, kind of like those areas. That's why I did it.
Yeah.
So what I just tell people is like, oh, how did I choose a market? Honestly, number one, just choose a market where you have an unfair advantage in. That's how I say it. Like, I have an unfair advantage in California because obviously I live here, and I have an unfair advantage in Oklahoma because I was referred a great property manager. So just scale in those two areas. You know, but if you were to look at metrics, what I kind of teach, you know, in the mentorship is like, you want to choose an area where there's job growth, which leads to population growth, which leads to rental demand. And then I want to choose areas in the Sun Belt. So if you draw a smiley face on the US map and anything below that, that's a Sun Belt. And then you want to buy in landlord friendly states, ideally. Oklahoma, I can evict someone in 15 days. They don't pay, 15-day notice, they're out. Right.
Yeah.
But, you know, I will say, like, you know, California is a bit hard to evict people, but you always have a demand for renters in California.
Yeah.
Like, it's guaranteed, but, you know, you're not going to be cash flowing as well. So that's how I chose Oklahoma. What type of markets were you looking for or looking at?
I was thinking of Ohio. I thought about Ohio, like Columbus metropolitan, outside of that, or Indianapolis, because Indianapolis has quite a bit of job growth, but I don't know about those winter states, you know.
Yeah, I'm not a big fan of winter because, you know, I'm an ignorant Californian, so I don't know anything about snow. But if your pipes burst from snow and freezing, that's going to be a lot of money, a lot of headache, and it's not worth it to me. So that's why I invest in the Sun Belt.
Or tornadoes of Oklahoma.
Yeah, Oklahoma has tornadoes and hail. So it's tornadoes, hail, Alabama. I mean, choose your poison, right? You know, California has fires, but I guess relatively speaking, not terrible. But yeah, my insurance went up by $5,000. My insurance was $20K for my 20 unit. It went up to $25K in 1 year because of everywhere it got hit with insurance. So a lot of people invest in like Houston, Texas. They got hit too. So, you know, it's pick your poison as well. That's why I said if you have a good team there, then by all means do it. But other than that, you know, obviously, I just try to avoid snow. But yeah, I guess if you avoid snow, you get tornadoes and hail. Yeah, I guess pick your tornadoes are very destructive in a small radius, right? Hail, yeah, that can damage your roof, break your windows. But snow, if you burst your pipes, like in Oklahoma did have that. There's a little freeze, the polar vortex, I think last year. Some apartments got hit, but you know, you have to buy good insurance. You know, that's what I teach. You have to buy really good insurance and it'll actually cover it'll cover the cost of repair, but also cover the missed rents as well.
Yeah. How did you come up with the financing for because you said you spent $300K on renovating that Oklahoma complex? Like, how did you come up? Was it just cash money that you have, or like how did you come up with that?
Yeah, so I took a loan. I cash out refinanced my single family homes in California that had a lot of equity. Okay. Remember, I mentioned earlier I had about $500K in just one property.
Oh, that one.
So when interest rates dropped, like during COVID to like, you're talking like 3%. I cashed out, refinanced a bunch of them, pulled out money, obviously leveraged my single family homes to the hill. So they're not cash flowing for me, but I was able to pull out a lot of money at 3% interest, which is almost free money at that point. And then now I was basically able to buy basically 2 apartment complexes and a mobile home park and fund my renovations for all of those. But on top of that, I have lines of credits. So through First Republic Bank, unfortunately, they kind of went bankrupt. They got bought
I love
by
the bank.
yeah, they got bought by
Chase.
Chase, but they gave you 100K personal line of credit unsecured.
Well, but I thought, I mean, okay, maybe I follow too closely with the books. You can't use it for like, you can only use it for your primary home and like family planning and student loans. You can't use it for other things. Like what?
That's what you tell when you apply, right? Maybe it is. I'm living in these homes. How do they know, right? I could be living in my apartment complex, but I just will say, once you're approved and you make your payments, you're good, right?
I remember that. My friend did that.
Yeah, once you make
for
your
other
payments,
things, yeah.
And then you know, if you have a 401k, you can take a loan against your 401k. If you have a whole life insurance, you can take a line of credit against your whole life insurance. If you have a stock portfolio, like I have one through Charles Schwab, I have a line of credit against that too. And these are my emergency reserves, right?
Yeah.
Sure. So I'm a little bit more leveraged than I would like to be. That's why I'm selling my mobile home park, to deleverage myself a little bit and, you know, stabilize my current assets. But that's how I was able to self-fund everything. I didn't need a partner. I funded everything, and, you know, didn't need to raise money, and, you know, did all this while working full time. And you see a lot of gurus saying, oh, I own like 100 units, but they partner, right? So they don't really own 100 units. They own a piece of 100 units.
Yeah.
Like a lot of people on SAR, they syndicate, and they're like, oh, I have like 200 units, but, you know, they partner 4 or 5 people. And when they talk to me, they're like, oh, do you syndicate? I'm like, no, I just own 90 units. I don't partner.
Yeah.
So, you know, it's different, right? And I'm the one managing everything. And usually the person you talk to on syndicators is this guy who memorizes PowerPoint, who doesn't know shit about operations. And they just regurgitate the same PowerPoint over and over, but they don't know anything about like how much it costs to renovate a kitchen, how much it costs to evict a tenant, like what are the landlord laws. They just regurgitate this like PowerPoint, right? So because I've done A through Z, like I kind of know at this point, like who actually knows what they're doing or who doesn't. So, and you obviously you will learn too if you buy your own and actually manage it yourself. So
yeah.
Did you do a BRRRR
on this? Oh, go ahead.
I was wondering if there's a DSCR lender that you would highly recommend.
Yeah, there's one that I'm working with. They're actually based in Irvine as well. You know, DSCR lenders, what's nice about them is, you know, obviously they're easier to work with. You don't have to show your W-2, you don't have to show any like documents. They just carry the DSCR as 1.25, but obviously you're going to pay a higher interest rate for that. So, you know, when I was refinancing my 20 unit, I thought about using a DSCR lender, but I got quoted 11%. But Bank of the West, which is who I used for my 26 unit, they gave me 7%. But it was such a pain in the butt to 90 days to do that cash out refinance, and they scrutinize everything. 3 years of tax returns. And let me tell you, if you renovate 40 units of real estate, your tax return is not going to look pretty. My tax return is ugly, despite working a full-time high-income W-2, relatively speaking, compared to most real estate investors. They scrutinize everything. Like, why did your W-2 income go down over the past 3 years? I was just like, well, I got laid off.
Yeah.
And number 2, I relocated from NorCal to SoCal, and they pay less here. So, you know, between those two, of course I'm gonna get paid less. So
that's not a DSCR loan. What kind of loan was it that you took out?
For the DSCR?
For the 26 unit.
I use Bank of the West for both. It's just a traditional financing, 25% down. It's recourse debt. And you know, my 26 unit, I had a 4% interest rate, 10 years fixed, amortized over 30 years. My 20 unit, it's 7%, and then it's 7-year fixed, and it's amortized over, I think, 30 years as well. So Bank of the West got bought by Bank of Montreal, so they're going through a transition. But I'm not sure if I mean, Bank of the West, because I'm in Oklahoma, it's a smaller market. Not many national lenders like lending there as much. So you have to be a little more flexible with that. But I know so many different lenders. Like I have so many brokers that I work with, as well as lenders I just know, because you need multiple lenders as you scale, right? Because like it's building that relationship, and that's how you like get low money down deals, right? Like if you build a relationship, that's how you get 10% down on apartment complexes. But you have to cash flow very well and buy it right. And the only way you can do that is if you go off market, to be honest, like truly off market with no broker involved.
Yeah.
So that it's covered.
What did you say, Kat? Having trouble hearing you.
Sorry, one more time, Kat.
What?
Oh yeah, I think we can't hear you. It sounds kind of muddy.
Yeah. Yeah. Hmm. Maybe type. I don't
Hello?
know.
Can you hear me?
Yeah, it's better.
Better? I just use the
Yeah.
computer. Hearing problems. So I was wondering, is it because like if you have, if you get from a broker, you're going to end up, the rent roll that you're collecting is essentially not that great to cover the debt service unless you go direct.
So the issue of the broker is, so what's the objective of the broker? They want to make a commission, right? So the higher the sales side price is,
Yeah.
and you get 3% commission, you do the math, they get paid more. So how do you justify a higher price? They inflate the net operating income. So what's net operating income? It's income minus expense. So what they do is they inflate the income by showing you pro forma rents, like what it could be. And they decrease the income, by saying, oh, the expense is only 30%. But any operator knows your expense is not 30%. I own 2 apartment complexes in Oklahoma. My expense is 55% on average. So by doing that, they're inflating the NOI, which inflates the value. So that's what they basically do. So because of that, I don't like it. And I will make an offer, like they'll list it for like 1.5 million. I'll just offer them $1 million. And I know they're going to say no. But I'm like, yeah, based on my calculations, assuming 25% down and whatever the interest rate is, this is how I'd hit the DSCR of 1.25. This is how my lender's going to underwrite it. So either A, give me the lower price, or B, I'll give you 1.5 million, but I want to seller financing on this deal. And I want terms so I can cash flow.
Mm-hmm.
So that's how I kind of negotiate. But a lot of times, once you say creative finance to a broker, they move on from you because it's too much work and they don't understand what it is. 90% of the time. So for me, I'd rather build trust directly with, the owner. And, just being in healthcare, I talk to a lot of patients. It's easy to build a relationship, or obviously a little bit more trusted. But just once you build that relationship, it's just so much easier to like negotiate it because basically they become the bank.
Mm-hmm.
And the bank needs to vet the person paying them, and they want to feel like they know and trust them. So
do they bring an agent to close, or
nope? We just me, no one in the middle, just me, and then the buyer, the seller, and title. That's it.
Oh, okay.
Yeah, I draft up the contract. I do everything. I work with the lender. I coordinate title. I do everything A through Z.
Even the guy, the lawyer that sold you the complex, you drafted that? He didn't draft that?
Oh, for that guy, he actually did draft it for me because he was actually a broker himself.
Okay.
He just did it to save money. But then when I saw his form, it was a generic form that you find online.
Got it.
Right. So once I saw that, I was just like, okay, I'm gonna do the same thing for my 20. So for my 20, I literally drafted the contract myself and I sent it over to him. He signed it. And after that, I just sent it to title and we opened escrow. That's it.
Got it.
Right. It's that easy. Like it's not rocket scientist. Like it's the easiest thing ever. Right. So, or worst case, if you have to pay a lawyer, then so what? Right. Like you pay a lawyer like something, but only like Alabama, they're a title attorney state. They don't have title companies. It's title attorneys only. But every other state, if you can reach out to like, what is it, American Title Company? Like there's so many of them. You can ask, hey, like I'm looking to make an offer. Do you have a sample purchase sale agreement that I can use? They might give it to you for free because they want your business. So like people freak out about that stuff. But yeah, obviously if you're doing creative financing, like Oklahoma, they have forms for creative financing as well. But if your
Mhm.
state doesn't have the forms, then at that point you might need to get like an attorney. But it's pretty basic, right? Like you want to keep the forms as simple as possible.
Mhm.
Like people tend to overcomplicate things. You know, like we work in healthcare, right? Sometimes we're guilty, we overcomplicate things, but half the time they don't even understand what they're saying. So you just dumb it down, like, okay, whatever. You're gonna carry $1 million at 5% interest only over the next 10 years. I'm gonna pay you this much every month. If I'm late on the 5th, then I pay whatever 5% late fee on top of that. And yeah, just pretty basic generic stuff, right? Like nothing out of the ordinary. And you can always hire an attorney if you want to do that.
Got it.
So I think that's just the fear that people have. Like, it's not as scary as you think. Like, I'm literally a pharmacist. I literally have nothing to do with real estate. My family doesn't do anything with real estate at all. Like, and I could figure it out, right? And that was even about my mentor. Like, he kind of didn't really help me after that. I've been kind of like on my own afterwards.
I'm curious because you pay quite a bit talking about the mentor. Like, what exactly that you thought was most helpful from his mentorship?
Honestly,
Because
so
it seems like you did a lot of things on your own. So I don't know if that helped you as much as
Just diving in.
mentors advertise. Like the mentors are like, my mentee did this, because it took my class. But like, I don't know how much the person helped you. I'm just curious.
So basically,
Yeah.
honestly, so yeah, my mentorship was like $15,000 to join, right? It ranges from 15K to 30K to 45K. And honestly, like I said, the education, it's nothing like new, like nothing you can't find online. Like even like my course in mentorship, right? But the difference is that it's just more structured. But what really helped me was just seeing people just like me who work the day job just like me buying apartment complexes left and right. And that gave me the hope because like I was just like you not too long ago. I'm like, oh, I own a couple of single family homes. I imagine you bought in Bakersfield is more affordable, right?
Yeah, exactly.
Compared to like OC. But I would never think like, oh, only Richie will buy apartment complexes. So once I saw people buying apartment complexes left and right, I was just like, wait, I could buy a 30-unit apartment complex for $1 million? Like what? And then because I was buying $1 million single family homes every year. To me, I was just like, well, $1 million is not out of my price range. I can do 25% down, whatever. And that's when I bought it, and then I scaled. But what makes me successful in that program, it just really depends how action oriented you are. Like, if you're willing to consistently send out letters like I was, if you're willing to make offers like I was, if you're willing to follow up with leads like I was, if you're willing to talk to multiple lenders, property managers, general contractors, if you really, like for me, if I really focus, I can find a deal in 6 months easily. Right now, I'm not even looking for a deal, right? But I know when I'm ready to buy, whenever that is, I can find a deal in 6 months, right? So that's where most people fail is they try it and they don't continue it, right? But for me, I'm the type where like I will do it until I get it. So it's really that. But then also my skill too is like I can figure things out pretty fast on the fly, right? Like you're gonna make mistakes. I made $100,000 worth of mistakes honestly over the past 2 years. So that's why I try to teach it in my channel and all that stuff. And when I kind of what I didn't like about that mentorship was that I felt like it wasn't realistic a bit as well. Like and then there was like no community. So I couldn't really see other people doing it. I was like, we didn't know who each other were. So it's kind of funny. Like a lot of them were actually reaching.
Oh, there's no like forums or anything.
Yeah,
like
I don't know like who, like it's all anonymous and like all that stuff. So like sometimes like they would reach out to me because they found out my channel. And they were just like attending my sessions. They're like, wow, your session is better than like that mentor sessions, and like mine are free. I don't even charge. Right? It's free. You just can hop on and ask me questions and I'll answer it. And post it. So, and then I'm pretty like honest about like what to expect when buying real estate, right? Like a lot of people, gurus, of course, they want to kind of give you the upside of it because they want to get you excited. They want you to, enjoy it, feel justified for your purchase price and all that, and all that. So, I definitely benefited from it. So, I can't knock on it. It definitely helped me scale, but you do have to give equity if you do partner with a mentor. So I had to
I
basically,
heard that. Yeah, I heard
yeah,
Randy told me
Wow.
that the first deal you gave him 50%, or
yeah, I
he
had to give him 50% equity, but to me, it just seems kind of like a little bit, how to
On
describe
top
it?
of the membership?
Yeah, it's just a
yeah.
little bit like, because if I lose money, it's not like he's gonna split half the cost,
Yeah. No.
right? But only when I make money, I have to give him half the money, right? So
Does he even put money into you or
no,
no?
no money in the deal. So
So
how
you were looking for a deal for him. That's basically what it.
basically it's
Yeah.
I find the deal, I finance it, and what he does is at the end, let's say if I cash out refinance it, he'll give me back my down payment, he'll give me back my renovation cost, he'll pay me 6% interest on my money that I invested in. And after that, we split 50-50 up to like half a million dollars. Right. So that's a great fee, right? And at this point, to be honest, he's not even helping me. I'm pretty much self running this thing
With all the
myself.
taxes.
Well, when we cash out refinance, there's no tax, right? It's tax.
Yeah. I mean, but
Yeah. So, I'm just like, wait a second, if I can do that, like that's what got me inspired. But I'm just like, I don't want to take like half of people's equity. Like my goal is just to like teach people and all that. So it just felt a little bit, a little predatory for me. But I can't knock any mentor because like, he helped me get to where I am. He changed my mindset to get me where I am today. He just removed that belief for me. But so definitely it shortcutted my success, and that's just the cost you have to pay if you want to shortcut yourself. So, that's why I try to do the same where, I can teach people, help them. Some of my other students, they bought apartment complexes in, like other states as well. Like some are targeting like Mississippi, some San Antonio, Texas. And like they just hop on and ask questions and I just answer it. So it's a lot more, I'm not getting an equity deal because I just doesn't think it's fair. Like, obviously, like, yeah, you kind of have some skin in the game. So I'm just like, great for him. That's a great business model for him. Like, but I think people only do one deal with him and then they kind of like go and do their own thing. So, I learned a lifelong skill from that, and I'm gonna take it for the rest of my life. Right, I'm still relatively pretty young. So, I mean, if I buy real
Yeah.
estate for the rest of for another 40 more years, I mean, I have way more wealth than I know what to do with, to be honest. So for that purpose, the consulting fee that I do have to pay in the grand scheme of things across my lifespan, it's worth it. Right. So, but yeah, I wouldn't ethically feel right doing the same. So unless I'm investing myself in the deal, right? Like if I'm signing my name on a loan, if I'm in, because sometimes like people put in the money, I can put in the knowledge, but no money and help with the operations. Right. But I didn't feel like that was really the case. So,
Yeah.
But yeah, at the time you're just freaking out. You want someone to hold your hand, right? It's your first deal. But once I did it, I was just like, oh, this is easy. I can do it myself. And that's
Yeah.
exactly what I did, right? So, but don't get me wrong. Like you could, I bought right. So most of my deals hit. My mobile home park, I'm probably gonna break even on that one. So, I just wasted 2 years and learned a lot about mobile home parks. Just to break even. But you can also lose money too. So I think for me, I just was hoping by having somebody a step or two ahead of me, it would mitigate my downside. But just by me buying it under market, already mitigated my downside. So once I learned that, I was like, oh, I don't necessarily need,
A broker.
or to give up that type of equity. So, so yeah, that's how I kind of thought about it. Obviously I'm a huge proponent of it because if you can shortcut your success, because basically there's two things in life: time and money. What do you value more right now? When you don't have money, you have time that you can give up. But when you have money, or you want your time back. So at that point, you start to buy back your time, right? That's the whole point of investing in real estate, right? Like I want to be able to afford a maid to clean my house. I don't have to clean it and to do that type of stuff. So you have to assess whether, time or money is more important for you, right? So that's what I kind of did. So most of my students, to be honest, they have kids, they working, they have elderly parents they're taking care of, so they have a lot of like obligations, and they're still trying to buy like real estate as well. So I understand kind of the struggles because I'm juggling. I'm living proof, right? I'm literally working full time. I commute like 2 hours a day.
Oh, geez.
Yeah, I'm managing 90 units, and then I still have time to like teach real estate,
Yeah.
right? So,
Mhm.
I know exactly what everyone's going through, and it's more realistic, right? So, versus people like, oh, I can teach you how to scale 100 units in a day or like in a year. So yeah, that's kind of my experience in mentorship. It just really depends how you like to learn. That's a lot I would describe it as.
Yeah.
Can I ask you a strategy question?
Yeah.
I guess I'm trying to picture in my head like the deal flow, because you had said that you renovate them, you bring up the value, like that one that was 800,000, and then now it's going to double, and then you're going to cash out refinance, and then you cash out refinance, but these are like 30-year amortized, but a at 7% or whatever it was for 7 years. At the end of the 7 years, then there's a balloon payment, right? For the rest
Correct.
of them.
So you
So,
have to refinance before then or sell it.
right. So if you're in the process of thinking of you want to build your portfolio, because my process is trying to just long-term hold and just getting
Mhm.
many apartments. What is in the strategy then? Because then actually at the 7-year mark, you're not actually looking to sell it. You're going to continue to keep, building your portfolio. If you keep selling, then you're just going to keep doing the same thing, which is just renovate and rinse and repeat.
Correct. So, basically with commercial real estate, yeah, it's typically fixed. You get 1 year fixed, 3 year fixed, 5, 7, and 10. So for me, so if you're fixed for 10 years, usually a higher interest rate versus if you're fixed for like, 1 or 3 years, right? So
But more risk.
yeah, because there's more risk.
Mhm.
So for me, I always encourage, people to do at least 7 to 10 years. The one thing you have to be cognizant of is the prepayment penalty. So it's a percentage of the loan. So how a prepayment penalty works is they call it 5, 4, 3, 2, 1. So year one, if you were to refinance a loan, you pay 5% of your loan amount. Year two, it's 4%. Year three, it's 3%. Year two, it's 2%. Year five, it's 1%. So it steps down, right?
Mhm.
But yes, if you do have like a 7 year loan or 10 year loan and it's due, yes, you're technically forced to do a refinance. So what most people do is, because remember, the value of your apartment complex is based on the net operating income. Well, what happens over the span of 7 years? Your rent will organically increase, right? So for me, my market rent is $700 right now. So when I bought it, it was 400. So I'm renovating it, fixing it up, and then I raised the rents from 400, which was below market, to 700, which is market. But then once 700 is the market, then every year organically the rent might go up by like 3%. So over 7, 10 years, your rent will go up pretty significantly. So now your NOI went up, right? And then the cap rate might even go down too. So that might increase the value. So you can do a refinance, cash out refinance where you're pulling out money again, right? Or you just can do a refinance where you just refinance it and then you just keep the same loan amount. You don't pull any money out, but you're forced to basically constantly refinance unless you just pay off your portfolio, right? Like that's what I was saying earlier. I'm not sure if you heard it, but my loan is only 390K for both of my apartment complexes. Once I'm done renting out all the units, I'm gonna cash flow 10K a month, right? 10K a month is 120K a year. If I took all the money back and reinvested back to my apartment complex, in 3 years, I'll pay off my apartment complex and I own it free and clear. And by then I might be grossing, maybe 20K a month, right? So, once you remove your loan, then you'll be like cash flowing like maybe, 13, 14K a month. So it depends how you want to do it. Like I was all about scale, scale, scale. But now that I'm going through a recession, this is my first recession I'm going through, to be honest. I was still in high school back in 08, so I wasn't there at that time. So this is the first time I'm going through a recession, and it's kind of making me learn that you kind of want to have what I call a financial foundation. So what's that financial foundation for me? That might be 2 paid off apartment complexes, right? That's grossing me 30K a month, and maybe I'm netting 20K a month. And once I'm netting 20K a month, I can basically leave my job, or if I don't mind working, continue to work my job and use that 20K to reinvest in more real estate, right? And at that point, you can then buy another apartment complex, and then you can start to scale again, and then build another foundation, right? So that's how I kind of pivoted myself. Because if I keep on leveraging, and let's say I keep on cash out refinance, because obviously, if it's 6 million, I do 75% loan to value, I can pull out like all my down payment, all my renovation costs, plus additional money on top, right? And obviously, I'm about to give some half to my mentor. So, so it just really depends. But I just will say that, like, to be honest, if you're buying real estate yourself, you don't need that many units as you think. Like, honestly, for me, my 50 units, I just can buy that, pay off, and stop. I'll be grossing 30K a month, and rents will organically increase. And then I can literally sell my single family homes, which have like a lot of equity in it, and then buy apartment complexes cash in another state. So it just really depends what your goal is. Like my goal was 20K a month net passive income, and then I would leave my day job. But I'm even kind of thinking now, like once you hit 20K a month, 30K a month, 40K a month, I mean, it's a lot of money, but like your quality of life won't improve that much, to be honest. Like once you just can have the option to leave your day job, and you free up your time, that point, you just can really focus on like what you want to do. So I'm a little bit more like lifestyle oriented. I don't know. I might have kids that hate real estate. They don't want to inherit my huge real estate portfolio, right? So that's always a fear, right? Or a possibility. So, it just really depends what your goal. But I think if you lay a financial foundation where you're not stressed, and because leverage is good, right? Like debt, there's good debt and bad debt. But at the end of the day, debt still kind of weighs on you. Like I'm 5 million in debt right now. Just real estate loans. No, wait, sorry. 7 million. I shortchanged myself. $7 million in debt, right? And I'm personally guaranteeing this debt. So if one apartment complex fails, they're gonna come after my single family homes or my other properties. But you can get non-recourse debt at a higher interest rate, where if you go bankrupt, they won't come after your other properties. They'll just take that property, right? But you have to pay for that higher interest rate. So I have thought about pivoting towards non-recourse debt as well. So, it really depends what your goal is for that. And your goal constantly changes. So I guess my question would be like, what is your goal? Like, what's your goal of the real estate, and how much real estate do you currently own right now?
For myself?
Yeah.
Yeah, my goal is to continue to just keep building long-term rentals so that at some point it, because I have a considerable amount in retirement, but I would like for half of it, half of my living to come from real estate and the other half to come from 401k and from my retirement money, because it's taxed differently, right? Because the real estate won't be taxed the way the money that I draw from retirement is, because I have a lot of money in retirement. And obviously I could do things differently in the way I put money away, because obviously I've been trying to, because of high wages, or high W-2, try to stock more money into the 401k being tax deferred. But at this point, it's a kind of a balance, because the more you put away, because I do mega backdoor and all these different things, the more you put away, you can't touch that, and so you have less money of this post-tax money to use towards investing in real estate. So
yeah, you lose liquidity, right? But you could self-direct your retirement account and buy real estate.
Yeah, I have a self-directed 401k, so I've been thinking about using it for a non-recourse loan.
But to me, to be honest, because real estate's a rate tax advantage, why would you use a tax advantage vehicle to buy a tax advantage vehicle, right? Like you want real estate to be, it's a rate tax advantage. So like,
exactly.
like scenario, like right now, I'm single, unmarried, W-2, but because I have so many losses off real estate, I can't write off my active income because I'm not a real estate professional, right? So my passive losses carry forward. But if I were to get married to somebody, and let's just say they work part-time, let's say they work 2 days a week, so 20 hours a week, but they do 21 hours in real estate, managing my real estate portfolio, they qualify as the real estate professional status.
Yeah.
In that point, my passive losses can offset my income, right? So it's actually worth it, actually more cost effective for whoever I marry to be part-time, so we can reap the benefits of real estate professional tax status, right? And that's what a lot of people I know do too, where like you have two high income earners, right? So if you're making 200K each, or 250K each, that's $500,000. Half that goes to taxes.
Yeah.
Right? You're paying 250K in taxes to Uncle Sam, and you pocket 250K. If one of you just like, let's say, quit your job completely, you only have 250K gross, but then you do real estate, and that real estate offsets your 250K, you pay zero in taxes. You have the same net, and one of you is working part, not even working. Right? So that's the beauty of real estate. Or if they work part-time, then you maybe be, grossing, close to 400,000, and then you can offset that income too with real estate.
Yeah.
So that's kind of the name of the game, right? Like it's how you play it for that. And when you're high income W2, we're very fortunate to be able to have this luxury, right? And like you said, the money's more liquid compared to the 401k. It's trapped there until you're like 60s, or I don't even know the age, but to me, I want to retire in my 40s. I don't want to retire in 60. So you kind of need access to some of that capital. So that's what's nice about real estate, is that it does allow some liquidity to an extent as well. So, definitely, doable to diversify, but it's kind of hard because like a lot of the wealthy people, what they do is you go all in on one thing. And once you've built your wealth through that, then you diversify. I'm not sure if that concept makes sense. So for me, I'm diving in headfirst into real estate. Don't get me wrong, I do like whole life insurance, max funded, and index funds. That's my liquid emergency fund. But I'm scaling a huge real estate portfolio. And at that point, when I want to be less active in real estate and just want to reap the benefits of all my hard work, because it takes 3 years to stabilize an apartment complex, right? Like to get it renovated, raise the rents, stabilize, new tenant base. I just want to sit back and enjoy my money, right? That's the point of real estate. So at that point, I might maybe invest more in index funds, 401k, all that stuff. So, like you said, it definitely varies, but honestly, it's probably gonna take at least 10 years to really stabilize a portfolio, especially if you're going to the multifamily realm. So single family is a bit faster to do it, but it's just not as scalable, right? Because single family is easy. You rent a tenant and you make cash flow day one, right? But then you have to buy because at one point I thought about buying 10 single family homes at cash flow 800 each, and that's 8K a month, right? But the problem is it kind of stays a little bit, you don't get as much appreciation. But versus apartment complex, you kind of get the tax benefits, more tax benefits up front, but you have the potential to always increase your rents every year. And it's like if you increase your rents by $50 and you only have one unit, you only get $50. But if you have 10 units, it's 500.
I'm curious about the appreciation with the apartment complexes. Like, are you seeing people do like midterm rental on some of those? Maybe it's small, not like the 20 unit, but maybe like 5+, like between 5 to like 10, and then their appreciation go up crazy because they do midterm rental and they can rent so much more than the typical long-term rental.
Yeah. So,
that?
I mean, it is a strategy that I even thought myself, where like, if you have, let's say two buildings and each are 10 units, one side can be long-term rentals for stability. And then one side can be kind of the midterm rental or short-term rentals even. I will say lenders, they look down upon, kind of weekly stays and monthly stays because it's riskier to them. But if you have a DSCR lender, they don't care as much. They just want to see the income and they want to see your track record. So if you do go down that route, because I tried to buy a 50-unit apartment complex where the guy was doing weekly leases. So it's basically like a hotel, right? But then my lenders were like, no, we want to see long-term leases because it's too risky for the lender. Right? So, you kind of, if you go that route, you might have to use a DSCR lender because they care more about just the DSCR, right? But your interest rate is not going to be as great. So that's something to consider. It's just going to limit your options. But it is a way to juice up your income potentially, right? But it typically, if I thought about midterm rentals too for my single family homes I own, if I can juice up those cash flow a bit, like I could probably retire off of it. Because right now I'm just like breaking even or negative off single family homes. So if I do midterm rental, then maybe if I actually make like $2,000-3,000 a month on each of them, then that can add up a little bit. But I do know it's a little bit more work and all that stuff. So, I was kind of learning from somebody who has like a VA team in the Philippines, and they train them to basically manage their like short-term rental and midterm rental portfolio and respond to the questions and all
Yeah.
that, but it takes time to like build that. So, but it is a possibility, right? Like if you pay free and clear, then whatever, you can do whatever you want with it. Or if you don't mind the DSCR lenders, you can do it
Got it.
too. So, you know, like
Mhm.
not to hinder any creativity, but that's what's beautiful about having 20 units, right? You can do it all of the above. Single family, it's
Yeah.
long-term, midterm, or short-term. You
Yeah.
can do all three in apartment
Mhm.
complex, right? If it's yours.
Okay. So basically your next strategy is if you're gonna acquire another apartment complex, you're looking for like seller financing and zero down,
Yeah.
right? That would be
So,
your strategy.
well, yeah, actually my next goal when I started, because I basically, all my capital's tied up, right? I basically used all my capital. I don't want to leverage anymore or pull on my own lines of credits. But yeah, I'd be looking to go off market, and whether it's single family homes or multifamily, if I can get it zero down and a cash flow, I'll take any deal, right? So that's what I'm going to try to do and approach in the next, like, honestly, year or two. With interest rates being so high, I think it's a good time to do that. But you know, obviously, I hit my mental capacity right now with 90 units. So once I sell my mobile park and once my apartments kind of stabilize, and I give myself a little break, you know, I'm really tired and burnt out from doing all this. To be honest, it's not easy, right? Like people make it seem easy, but I'm a one-man show, right? Essentially. So, but I am looking to kind of buy deals zero, really low down. Like, you know, like if they want 20% down, what I tell them was like, well, can I give you 5% a year over the next 4 years? And then use that cash flow from the apartment complex to cover that 5% down. That's zero down, right? So there's ways to structure it creatively to get that. But the key is building that relationship with people.
Yeah.
And that takes time and patience. And I will have time and patience given this next, you know, kind of cycle.
Yeah.
Yeah. Any other questions? So what's kind of your goal and time frame like to buy?
Me? No, Cat. Go Cat.
No, you.
Cat has more capital than I do.
I do
She has
not.
more
All of
experience.
mine's in retirement.
Yeah, like what
But you can pull it out.
like what type of time window are you looking to kind of buy? And then like what type of capital? Because that'll determine how much you can buy, right? Because if you're doing renovation, you know, it's about 10K per door, right? So plus your 25% down payment. So you kind of know what your purchase price is. And then based on the purchase price, you can kind of figure out a market. So you kind of work backwards from what you had. That's what I did, you know, kind of starting off.
Well, honestly, I'm looking to. I have a house, a single family in Glendora, so I'm looking to take the equity out of that because I've already done a cash out refinance, and it's appreciated beyond that. And so there's all this trapped equity. And one thing about California, I'd say, is all the single family homes. It's just what people are willing to pay, right? And people are willing to pay a lot, for a single family home because they just need a place to live. And so I want to just try to take advantage of that in this current market, get out of that, and then take the equity and put it in an apartment complex or maybe to more units, because right now it's about trying to grow as quickly as I can the next 10 years to the point when I retire, and that I can use those units as income on top of my retirement money.
Yeah, so basically, because you live in your primary residence, when you sell it, it's all tax free, up to like I think half a million or something like that, or 250K to $500,000. So you basically can take that tax free, not to do a 1031 exchange. I'm not sure how much equity there's beyond that. Then you might want to consider 1031 exchange. But what I tell people to do is you do a reverse 1031 exchange. You buy the apartment complex first, then you sell your single family home and shift all of the equity into the apartment because it makes it less. Yeah, because it's less stressful. Because if you're forced in, you know, one of my students was forced in 6 months to have to find something, and I was telling him, like, do not feel pressured. If you have to pay capital gains tax, just pay it. Because if you force yourself to buy a bad deal, you'll lose way more money on that bad deal than you would paying taxes. But if you were to do a reverse 1031 exchange, it's less stress because it's easier to sell a single family home in California than it is to find a good apartment complex. Right? Like guarantee you, if you want to sell your single family home, you can do it in 6 months. That's easy.
Yeah.
Right. So that's what I always tell people, like, do it reverse. But the problem with that is you need the capital first to be able to front the money. Then you get it reimbursed to yourself. So that's what a hack that I do. And, I might do that myself, to be honest. I call my single family homes in California little piggy banks, just smash it, take the equity and buy apartment complexes. And, smash it, buy apartment complexes. And if your goal is like 20K a month, then, whatever, get like a little 30 unit that pays, 700 each. And then once that is paid off, at that point, that's your retirement, right? And you own it yourself, no bank. And then that's all you need. So like, you don't need as much real estate as you think, right? Like I thought I needed I was chasing a number of 100 just to sound cool. I pretty much, I'm at 90, but my mobile park has more than that. I just didn't fill up. But with 50 units paid off, I mean, that's enough to like live a very good lifestyle, and have a retirement and, do it within 10 years. Right. So if you do pick a lower end market, you can take your equity. Let's say you have $500,000, you can buy $1 million apartment complex that has 30 units. You only have a high 500K loan, and you stabilize that over 10 years, you can probably pay it off, to be honest, in 10 years. And at that point, you just begin on this cash flow front. You might even need to touch your 401K, right? With that. So, that's what I'm trying to do. And because I'm trying to retire early. I don't want to ideally not work if I don't have to. Unless I have a remote job one day, maybe I'll continue working. But if I have to show up, then I prefer to have the option to at least retire. It's more fulfilling for me to teach people than it is to actually do my day-to-day pharmacy job. But when you said 10 years, I find it very believable. So I know you can do it in 10 years. The key is just how many years does it take you to get started?
Well, see, initially I was thinking like if I buy a property, whether it's because it was initially just the 2 to 4, because it's easier to qualify for just conventional loans. So I thought, okay, if I buy anywhere from a duplex to quadplex, 1 to 2 a year, then I can get there. But, just seeing people doing apartments, it's just like, you can't do it in California, but if you do it somewhere else, you could totally scale up quickly.
Yeah, that's what I did, right? Like
you don't need a 2 to 4 every, 1 to 2 a year. You could just do several deals in the next few years and get there.
Yeah, like you can buy like what I did, or I bought 26 units. I bought 46 units for collectively 850K. Right. So and then what's nice about smaller loan size is you can pay it off faster too if you want to.
Mm-hmm.
And it's not as much of a burden on you. So you can totally do that, right? You can trade up you can sell your single family home and go in a cheaper market in the Southeast and get 10, 20 units and then basically work to pay that off. If you still don't mind working your job and throwing extra money at it, then boom, you paid off. That's your retirement. And then at that point, if you're retired and you're bored, you can buy more real estate if you want to. So it's just so many options out there, but you have to, most of the big real estate people who retire from it, they've been doing it 10, 15 years. All right. I'm only on year 6. So, it definitely takes a while to build up. But the key is just getting started, to be honest, because time will fly. Time will fly.
Yeah.
For that. So that's what led to my success. I'm just action oriented, but a little bit too a fault. I scaled a little too fast. I'll be honest. About 80 units in 8 months, and I had 2 50 plexes under contract during that same 8-month window. So I almost could have bought 180 units in like 8 months. Yeah. Yeah. Good thing I didn't. I wouldn't have any hair if I did from all that stress.
This is like real estate on meth or something like that.
Yeah, like I said, my story is like, just for context, I'm the 1%. Like not many people are doing what I'm doing alone. Right?
Yeah.
Most people are doing what I'm doing, syndicating.
True. Yeah.
Right? But think about it. If I can buy these apartment complexes in Oklahoma, if I were to come across 100 units, I can easily syndicate because I already have I have a team, I have a track record, I have systems in place, I know the rents, I know the market. At that point, it's easy for me to raise money. People probably throw money at me. you know. So, but that's if I want to go down that route. I'm not sure if I do, because that's another job, right? I'm not sure if I want to do that. I'd rather just buy little apartments myself, and I can wholesale these bigger deals to other people. But you know, it just really depends on like what you want to do.
Did you have flip experience before you bought your apartment complex?
I do not. Just like what Kat said, I don't believe in like flipping wholesaling, because it's a one-time fee and you're always working, right? And you get to pay taxes on it, ordinary income tax on it. So for me, I'm always buy and hold, unless you know it doesn't make sense, and then I'll sell, right? I try not to sell, but I usually go into a mindset of buying and holding, because that's how you build wealth, right? You know, like people who fix and flip, they regret it. Like I know people who fix and flip like 50 homes a year in Vegas, and they started back in 2010. Had they kept all those single family homes, they'd have a nice portfolio that appreciated, you know, that doubled over the past 10 years. So for me, I'm all about keeping it. And that's how you build true wealth, right? Imagine if it's a 30-year loan, even single family home, you pay it off in 30 years. I mean, you know, you can have a couple single family homes in California that are paid off, each giving you $4K a month, times 5, that's $20K. You know, you just have to pay property manager, property tax, insurance, and repairs. Like that's a way to go too. If you don't mind the 30-year route. My problem was I wanted to retire at 35, and I was really ambitious in trying to do that. But I burnt myself out trying to do it. And that's why I bought so much real estate, because I wanted to retire as fast as possible. But you know, ended up burning myself out doing it because I went a little too fast, obviously. And then when you make a mistake, I make a mistake on not one unit, I make a mistake on 90 units. So that's when it starts to compound. Yeah. So yeah, like you said, I'm super action oriented. Like, you know, I listen to a lot of YouTube podcasts, send mailers, made offers. I was making like 5-6 offers a week for context. Offers that made sense for me. And then, yeah, like I said, if you really put your mind to it and you're really serious and action oriented, you can get a deal in 6 months if you push it, right?
Yeah.
But if you stop and don't do it, that's when you don't get the deals. Because the more you underwrite deals, the more you make offers, the more it's like reps, right? Like we don't become doctors immediately, right? It takes like 8-10 years to do it. And it's a layered learning model, right? When you're P1, you learn from a P2, P2 learns from P3, P3 learns from P4. Like, that's the same thing in real estate. Like you want to learn from somebody one step ahead of you. If you want to get to where I'm going, learn from someone like me. If you want to syndicate 1,000 units, then I'm probably not the best person to learn from, because that's not my model, right? So it just really depends on what you want to do.
How many offers did you make, would you say, before like you would get like a hit?
Yeah, I mean, it like I said, I was making 5 offers a week, right? And it took me, I think I started sending mailers in March. I got my first deal in June under contract. So 3 months.
Wow.
Yeah. But I was constantly calling brokers, writing offers, following up with people, trying to network. Like I was going at it, you know, like viciously going at it and being persistent. And because every time you do the reps, that's how you learn, right? Like you don't just master something one time. Like you have to do the reps, and how to talk to owners is a different skill. I mean, fortunately, you know, we're on healthcare, so I think we're a little bit more natural at it, but some people are terrible at it. And I just said, that's how you get the deal. The difference between getting the deal and not getting the deal is how you talk to them. That's it. It's not even about what the letter is. It's how you talk to them, and build that trust, and then to make it a win-win situation for you both. So yeah, that's kind of how it is. The people that fail, they just don't take the consistent action. And like I say, it's just a numbers game, right? Like you put a certain number of offers out, eventually someone will say yes to your offer. And worst case, if they say no, it gets you to learn about the market and how things are. So, and sometimes when you write the offer, even if it's low, they may call you back in like 3 months and be like, oh, are you still interested? That happened to me on my 20 unit. I wrote an offer, I didn't like it. And he called me back like 3 months later. He's like, you still interested? And I was like, yeah. And that's the deal. So just showing that because a lot of people are not action oriented. Like, you know, I'm saying a mobile park, like, man, people say, oh, I'm gonna make you an offer, and they don't. Now I don't take them seriously, right? Like I'll post on a Facebook forum, I get like 300 messages not one of them, maybe 3 out of 300 are serious or actually take action. So just by you taking action, you're already in the 1%, right? And I'm living proof of that. I mean, if you have the capital, that's usually the hard part. But once you have that capital, the next thing is just getting that deal. And it just takes one deal to really hit whatever objective you both have.
Wait, when you said you gave them an offer, did you actually give him like, you had a typed up like written offer, or was it just a verbal offer? Like when you're
No, you have to give an actual written offer. So it's called a LOI, letter of intent. So there's templates out there. I have one in my mentorship that I use, but they're out. You just Google it, letter of intent template. But it's very simple, right? Just like, what's the offer price? What's the earnest money deposit? Due diligence time window? How long to close? It just lists everything out, right? What title company do you want to use? What are the terms? And then it's a non-binding agreement. And once they sign it, that's when you do the official purchase and sale agreement, right? So, but because what was that?
It's like you were the agent. Like
I am the agent. I did everything. I'm serious. I'm speaking from experience that brokers and realtors are useless, because I did it myself, and it's actually easier, like, to communicate directly, and it builds that trust. And like, I literally did it myself. Like, it's not hard. It's literally not hard, like, at all. Like, like pharmacotherapy
Why were you talking
is
to
harder.
brokers? You said you were talking to brokers but you were doing.
Well, because I want to learn as much as possible, right? Who knows? Maybe one broker might bring me a good deal. I don't know, right? Or worst case, but brokers, from my experience, you check out my channel. I underwrote a bunch of deals that brokers sent to me off market. They're terrible. You can look at some of my videos. I underwrote those live. But I just was doing it just to understand what the value is of the properties. And who knows? They might bring me a good deal down the road, but I'd rather take it to my own control and then do it. I was only doing it just to learn and meet people, talk and learn. That's it. It wasn't because I knew they weren't going to give me a good deal. I still don't think they're going to give me a good deal. And I purposely, I brought a broker on to one of my podcasts, and even he was just like, yeah, most brokers are terrible. And the brokers who are good, they're not going to want to work with people like us because we're new. So, that's the game that we have to play. So that's why I went off market. With direct mail.
Brokers, especially for these multifamily, these apartments. So I'm talking to one of them. They do a direct mail campaign. That's where they're getting their units. That's where they're getting their sellers, and then they bring it to you, and they've already set it to a certain price, and they're going to get commission off of that. So
exactly, but then once they're involved, they're already jacking up the price. You already said the word, right? So if you cut that broker, then that's how you make the money, and you pocket the difference. Because I made $250K. If I had a broker in that deal, the broker, or maybe the person would have made more money, but the broker would have made more money too. So I say brokers make you broke. It's written in there.
Wouldn't they? But I'm curious, because it's only a percentage. Wouldn't they just want to be like, hey, I will bring you a deal, but you give me like quote-unquote sign-on bonus, but not dependent on like, percentage.
They could, or they can wholesale the deal, right? And they pocket.
Oh yeah, that's the term. Yeah,
right. They can wholesale. Like, okay, well, I'll get it under you for contract for $600K, and if I sell for $800, then I pocket $200K myself. But I can do the same too, right? If I get a deal. So to me, I've never had a broker give me any value at all, and I've analyzed thousands of deals myself with students, and did direct mail myself, and I've never had a wholesaler bring me a good deal, a broker bring me a good deal. So, maybe one of you can prove me wrong, hopefully. But so far, I've not seen it. And, based on pure probability, the chance of someone new getting a good deal from a broker, it's like 1%. Not like it can't happen. Like, my mobile home park was brought to me by a broker, and guess what? That's the one deal that I'm like losing money on, right? Had I bought it off market myself, I probably could have bought it with some margin and mitigated my downside and not lose money on it. So like I said, I'd rather just go myself direct to and a lot of people don't trust brokers either. Like, I don't trust brokers now after my experience working with them. So a lot of owners think the same way. Who own an apartment complex, they got money, right? If you own an apartment complex, you have money. So sometimes they'd rather just work with somebody that they like and know and they trust, and what's more trustworthy than a doctor, right? to want to work with.
Awesome.
So, you know, what leverage your 8 years of blood, sweat, and tears for that.
Cool.
Yeah. Any other questions?
No, I don't have any other. Yeah, this is really good. I was taking notes.
Okay, cool. Yeah,
I was trying
hopefully,
to write things down so I remember. Cause yeah.
hopefully, you learned something. And like you said, I talk a lot about real estate on my channel, so I just listen. Whatever topic it is, there's already a video on there, as well. And you know, I'm pretty detail oriented, so like I'm working on some videos where I'm analyzing my appraisal reports. I'm analyzing my purchase and sale agreements that I wrote up. I'm analyzing like my rent rolls, like all that stuff, just to give transparency out there, and no other YouTuber is doing that. So I wanted to like offer that to people who want to learn and actually see the weeds. So yeah, hopefully you guys found it valuable.
Yeah.
All right, cool.
Thank you.
Well, thanks for hopping on, and yeah, feel free to
Yeah.
reach out if you have any like
Yes.
questions or know anyone that wants to learn. Happy to talk to people and answer any questions. And if you have additional questions, just shoot them over my way. Happy to help where I can.
Thanks.
Yeah. Thanks, Steven.
Yeah. All right. Have a good night, guys.
Have a good night. Bye.
Bye-bye.